Iliad has been undergoing significant changes for the last few years. This includes launching the new Buco brand that we utilize in the General Building Materials division, which represents 80% of the group's turnover. Further to this, we've gone through the comprehensive process of integrating various IT systems onto a single ERP platform. In 2013, we made significant portfolio adjustments, closing 2 stores, but also selling off our ceramics cash and carry, and timber wholesale businesses. It was therefore very important to us to, in 2014, deliver a result that reflects the underlying health of the group. And we are very pleased to say that we believe we've achieved just that. Headline earnings per share up from 40 cents to 72.3 cents, an increase of approximately 80%. Against a continued changing trading environment, with revenue on comparable stores increasing with 2.2%, we managed to increase gross margins, the percentage, by 1.2%, a culmination of a few factors, mainly internal synergies. The portfolio adjustments made an impact. Also, the integrated ERP platform allowed us to manage our stock more effectively. And by creating synergies and utilizing the size of the Iliad basket, we've made some gains on the rebate line. As always, we've kept the pencil sharp on the expense line, an effective tax rate that is slightly down on the prior year. And as a reflection of our strong balance sheet, the net finance costs have reduced with the influx of cash from disposals in 2013 and 2014, as well as the increased cash profits. All in all, delivering a result that we believe has met the market expectations. Moving forward, and with this stable platform, we believe that we are able to strongly garnish and look for significant growth. We approach that from 3 angles. Firstly, organic growth, where we rely heavily on the investment in our Buco brand. Secondly, the rollout of new stores. And it's pleasing to note that in Q4 of 2014, we opened up 2 stores, one in Komatipoort in Mpumalanga, and the other in Paarl in the Western Cape. We will continue with this process. Thirdly, from an expansion point of view, we will consider appropriate acquisition opportunities. So an improved top line whilst keeping our disciplines in the balance of the business, we believe positions us well for sustainable growth into the future. From an industry perspective, I earlier commented on the fact that the environment remains competitive. From our perspective, we noticed that the cash segment of the market, the DIY segment, is quite buoyant compared to a credit or contractor segment of the market where they operate both in the residential and the non-residential markets, which is slightly more constrained given certain macroeconomic factors and also infrastructure spend that's slightly lower than expected and required. Having said this, opportunities for growth are still there, and we look forward to doing what it takes to grow the business from this space.